trying to keep up with the global economy. It often feels like trying to read, I don't know, War and Peace while riding a roller coaster, right?
Oh, yeah, that's a good way to put it.
Just when you think you've got a handle on one chapter, another 100 pages of data just hits you. Mountains of data, endless spreadsheets.
Yeah.
It can feel like trying to find a needle in a haystack.
Totally.
But don't worry, that's exactly why we're here, to sort of cut through that complexity and, distill the signals from all the noise.
Exactly. Welcome, everyone. We're diving deep into the latest economic pulses today. We're sifting through, quite a stack of sources, primarily the two Black Dot and Tima Weekly Financial and Economic Bulletin from July 28th, 2025, and the Ministry of Treasury and Finance Monthly Budget Report for June, plus a whole load of other weekly economic bits.
Right.
And our mission really is to pull out those crucial nuggets of knowledge, connect the dots between numbers that might seem unrelated, and help you, our listener, understand the key trends and the implications without getting totally bogged down.
Yeah, making sense of it all.
It's about piecing together that coherent story, the interplay between government policy, central bank actions, and how it all plays out in the real world.
Okay, let's unpack this then. We've got a fantastic snapshot of the Turkish economy today with some really vital global context woven in. Think of us as your financial detective agency for the day.
Sounds good.
We're here to highlight what truly matters. So let's kick things off with the macro outlook. Specifically, that government budget data for January through June of 2025. What's the headline here? What's the big picture?
Well, the big picture is that the central government budget deficit, it swelled to $980.5 billion.
Wow.
Yeah, that's a pretty chunky 31% increase compared to the same period last year. So definitely more money going out than coming in. Quite significantly.
That's a considerable jump. But,
Yeah.
What really stood out to me was the non-interest surplus. It flipped from a deficit of about $173 billion last year to a surplus of $130.9 billion this year. That's a huge shift. What does that tell us about the government's fiscal approach, especially when, total revenues jumped 46% and expenditures were up almost 44%?
You've really hit on a critical point there. That shift to a non-interest surplus, it's not just a minor detail. It's a really critical signal.
Okay.
It suggests the government is now covering its, let's say, day-to-day operations, essentially. It's running costs, excluding the interest on its debt, purely from its current tax revenue.
Oh, okay. So operational costs are covered.
Exactly. And that's a foundational step towards, fiscal sustainability. Even as the overall deficit balloons because of past borrowing, it means they're not digging a deeper hole for present spending, but they're really struggling with the legacy of debt.
That distinction, between the operational side and the debt servicing is really important. Now let's break down those revenues, especially the tax side. Income tax collections nearly doubled up a staggering 96.5% to over $1.1 trillion.
Huge jump.
But then corporate tax only increased by, about 16%? And here's the kicker for me. Indirect taxes, VAT, excise duties, things that hit everyone, they now make up almost 2/3 of total tax revenues.
Yeah, 64.5%.
What does that heavy reliance tell us about the approach and maybe the impact on everyday folks?
Well, when a government relies so heavily on indirect taxes, basically, taxes on consumption like sales tax or fuel duties, it's a bit of a double-edged sword. On one hand, they're often easier to collect, but on the other, these taxes are typically regressive, meaning they tend to take a larger percentage of income from lower-earning individuals simply because a bigger chunk of their income goes towards essential goods and services that get taxed.
Right, things you can't avoid buying.
Exactly. So this can really impact economic equity, and it could potentially dampen overall consumer spending.
Yeah.
It creates a different kind of economic pressure than, say, direct taxes like income or corporate tax.
And speaking of pressure, when we look at the expenditure side, what's really eating up the budget?
Yeah.
Because despite that non-interest surplus you mentioned, the overall deficit is still growing.
Yeah, the surge in interest expenses, that's really the elephant in the room. They nearly doubled up 93.5% to $1.111 trillion.
Wow, almost doubled.
It now consumes almost 17% of total budget expenses. This acts like a massive drag on public finances, essentially eating away at any gains made through higher tax collection or, other fiscal adjustments.
So it's the cost of past borrowing catching up?
Absolutely. It's the compounding cost of past debt, making it incredibly challenging for the government to achieve genuine fiscal health, regardless of other efforts. Current transfers like social benefits, they're still the largest slice at 38.2%, and personnel expenses take up another 26.6%.
Okay, so we've dissected the government's fiscal position. But of course, monetary policy plays an equally crucial role, right?
For sure.
How do the central bank's recent moves, particularly their interest rate decision, tie into this economic landscape? And crucially, what's happening with the country's reserves?
Well, this brings us directly to the central bank's Monetary Policy Committee. They lowered the policy rate by 300 basis points down to 43% at their July meeting.
Which was a bit more than expected, right?
Yeah, just slightly. The market was looking for maybe 43.5%. Now, what's fascinating here is that despite this rate cut, the country's gross reserves have actually continued to climb. They reached $168.6 billion as of July 18th.
Okay.
And maybe more importantly, the net reserves, if you exclude the swap agreements, they increased to $44.3 billion.
So more breathing room there.
Seems like it.
Yeah.
And this, coupled with a $1.9 billion increase in foreign currency deposits and net purchases of over $500 million in domestic debt and equities by foreign investors, well, it suggests that even though rates are coming down, there's still a significant inflow of foreign funds, maybe driven by confidence, maybe by attractive yields elsewhere.
Okay, this next piece of the puzzle is quite complex, I think. We've got inflation expectations nudging down, which sounds good on the surface.
Mm-hmm.
But then the market's outlook for the exchange rate, for the lira, is actually increasing. People expect it to weaken further. How do we make sense of that? What is that divergence signal?
Yeah, that's a really critical question about the market's long-term view on stability. The central bank's own market participants survey for July shows year-end consumer inflation expectations actually decreasing slightly, now at 29.66%.
Okay, slight drop.
And the 12-month and 24-month expectations are also falling. So that's a positive sign, right? Suggests disinflation efforts might be gaining some traction.
Nah.
But simultaneously, the year-end USD TRY expectation increased to 43.72, and the 12-month expectation rose to 47.70.
So inflation down, but lira expected to be weaker.
Exactly. This divergence suggests that even as those immediate inflationary pressures might be easing, market participants still anticipate continued depreciation of the local currency. It's a real tension between the central bank's, easing monetary policy and these persistent market concerns about currency stability.
What could be driving that concern then?
Well, perhaps it reflects doubts about the long-term disinflation path, or maybe concerns about the government's overall economic strategy, or even just the impact of those rate cuts themselves.
A real tug of war, isn't it? Okay, let's shift focus a bit now from these high-level macro numbers to how businesses are actually feeling on the ground. What do the confidence indices tell us? What's the pulse of the real sector?
Well, the picture from the real sector is pretty mixed, actually. Manufacturing industry capacity utilization, it decreased slightly by 0.3 points to 74.1% in July. So a slight cooling of production there.
Okay.
However, the real sector confidence index, the RKGE, it actually nudged up by 0.5 point to 98.9. Now, it's still just below that 100-point threshold for optimism.
Right, 100 is the neutral point.
Exactly. But this small increase, they're calling it a healing signal, suggests that while sentiment isn't exactly exuberant, it is improving somewhat.
But then the financial sector.
Yeah, in stark contrast, the Financial Services Confidence Index, the FHCE, saw a really significant drop, 9.2 points. Though it has to be said, it remains quite optimistic overall at 162.0.
So manufacturers feeling slightly better, financial services maybe a bit more cautious.
That's how it looks. It suggests maybe cautious optimism in manufacturing, but perhaps some hesitations among financial service providers who might be more sensitive to those monetary policy shifts or, the currency volatility we just talked about.
And what are businesses expecting for the next 3 months? Particularly looking at production and orders, are they feeling more confident about future demand?
They seem to be showing cautious optimism. We see expectations for production volume and total order quantity for the next 3 months are generally on the rise.
Okay, that's positive.
Yeah, and interestingly, while export orders apparently weakened in their valuations for the last 3 months, there's an anticipated increase for the next 3 months.
So a potential rebound in exports.
Potentially. This dynamic suggests that maybe domestic demand has been the more significant driver recently, providing that baseline support, while export orders are maybe showing signs of a recovery or at least stabilizing.
Okay, so given all these dynamics, the budget, the central bank, the mixed confidence signals, how are the markets actually responding day to day, week to week? Are we seeing stability or is it still a choppy ride?
Well, the weekly market indicators, they reveal a varied landscape, as you might expect. The USD2 saw a slight depreciation of the lira, moving from 40.40 to 40.52 over the week.
Okay, small move.
Yeah. Yet the BBS 100, the main stock index, actually showed positive performance in lira terms, up 2.2%.
Interesting.
And here's a truly significant shift, I think, especially for anyone tracking Turkey's international standing. The 5-year credit default swap, the CDS.
Right, the risk premium.
Exactly, the insurance cost against default. It dropped quite notably from 284 basis points down to about 272.
That's a decent drop. What does that signal?
It's a measurable decrease in perceived country risk among international investors. It really suggests improving sentiment on that front, despite the slight currency depreciation we saw, which might be more influenced by domestic monetary policy or those ongoing inflation concerns.
So less worry about default risk, even if the currency is still under a bit of pressure.
Seems to be the case, yeah. Elsewhere, gold regressed slightly. Brent oil prices dipped a bit, suggesting maybe sluggish global demand. But the Baltic Index, which tracks freight costs, actually rose. So mixed signals there, too.
Right. And that brings us to the global context. Turkey isn't operating in a vacuum, obviously. What signals are coming from major economies like the U.S. and the Eurozone? How might that impact the local picture?
Well, what's striking here is the mixed bag coming out of the U.S. especially. And that creates a pretty uncertain backdrop that economies like Turkey have to navigate.
How so?
We saw a surprisingly strong U.S. services PMI at 55.2, indicating robust consumer activity over there. But the manufacturing PMI actually showed contraction at 49.5, below expectations.
So services strong, manufacturing weak in the U.S.
Exactly. That divergence in the world's largest economy creates a kind of push-pull effect for countries like Turkey. Maybe strong demand for services imports, but potential headwinds for goods exports.
Okay.
U.S. jobless claims also came in lower than expected, which is a positive sign for their labor market. Meanwhile, over in Europe, the ECB held its rate steady at 2.0%, signaling, caution from a major trading partner. That impacts capital flows, investment sentiment. It all feeds back.
Right. It's all interconnected. Let's quickly touch on a couple of other crucial financial indicators back home. First, the KKM volume, those FX-protected deposits, what's happening there, and then the real sector's foreign exchange balance.
Okay, so this really raises an important question about those ongoing efforts to, de-dollarize or shift away from foreign currency-protected instruments. The KKM volume itself actually decreased by about 2.9% week on week, down to 506 billion.
So that's moving in the desired direction.
Persists. That's a sign of that desired shift. However, a significant structural vulnerability, it seems, remains. The real sector's overall FX deficit, that's Turkish companies as a whole, it actually increased by $2 billion to $176.2 billion back in May.
So companies collectively owe a lot more foreign currency than they hold?
Significantly more, yes.
Yeah.
And think about what that means. It makes them highly susceptible to any depreciation of the local currency because their foreign currency debts just become more expensive to pay back in lira terms.
A big risk factor.
It's a fundamental challenge for the stability of the corporate sector. On a slightly more positive note, the short-term foreign exchange deficit did decrease a bit, down to $7.9 billion.
Okay. Finally, let's look at the individual investor. What's happening in the local stock and mutual fund markets? You mentioned a curious trend here. A slight decrease in the number of stock market investors, yet the total investment amount actually increased. What's going on there?
Yeah, this is truly fascinating. According to the Central Registry Agency data for July 18th, the number of individual stock market investors dipped slightly to around 6.4 million people.
Okay.
Yet the total amount of investments held in the stock market increased significantly to 15.79 trillion.
So fewer people, but more money overall.
Exactly. This dynamic, where fewer individuals hold more value, could signal a concentration of investments. Perhaps larger players are entering, or maybe existing investors are just increasing their average investment size.
Interesting. What about mutual funds?
Well, the trend is different. The number of investors in mutual funds actually increased to over 5.6 million, and their total market capitalization also rose to nearly 6.6 trillion.
So maybe a shift in strategy.
It could point to changing investor strategies, yeah. Perhaps a move towards more institutional or consolidated investments directly in the stock market, while mutual funds continue to attract broader, maybe smaller scale participation.
So putting it all together then, what does this mean for you, our listener? We've unpacked a really fascinating, if definitely complex, set of economic data today.
Yeah, quite a mix.
We've seen this blend of government efforts towards, budget tightening on the operational side, but still grappling with these huge debt servicing costs. We've got a central bank cutting interest rates and this persistent tug of war between falling inflation expectations and rising exchange rate expectations. The real sector showing some cautious optimism, but global signals are certainly mixed. It's a challenging environment.
It really is. And if we connect this back to the bigger picture, it's just a testament to the dynamic nature of economic forces at play, isn't it? Understanding these shifts, these divergences, is absolutely key to being well informed. And it's always, always about looking at the data holistically, not just grabbing onto isolated pockets.
Absolutely. Seeing the whole forest, not just the trees.
Exactly. And as you consider all these interconnected figures we've discussed, maybe we can leave you with a thought to mull over. It's from the economist Milton Friedman, who famously said, "The cause of inflation is not the consumer, the producer, the union, or the import. The money printing machine is only in Washington." Or, insert relevant capital city. Inflation is created by a government that overspends and prints too much money.
A provocative thought.
It is. Consider how that statement might apply to the budget data we discussed, particularly that rising overall deficit and the soaring interest expenses, or maybe the central bank's policy rate decisions. What does that perspective suggest about the ultimate drivers of the inflation and exchange rate trends we've just explored in this deep dive? And, what might it make you ponder about economic policy going forward? Something to think about.